Okay, so you want to own a Pepsi factory. $93.9 billion in revenue last year. Products sold in more than 200 countries. A brand that has been at war with the same competitor since 1898. And unlike a lot of businesses on this channel, you can actually buy the machine that makes it. The land, the lines, the trucks. So you buy it. Here is the problem nobody mentions at the closing table. You just bought the part of PepsiCo that PepsiCo's own investors are trying to get rid of. By the end of this video, you will understand why the division that owns every one of those factories delivers a fraction of the company's profit, while the potato chips carry almost half of it. You will understand why a tariff on imported aluminum raised the price of aluminum that was never imported. You will understand why the man who invented Pepsi was destroyed by the cheapest ingredient in the bottle. And you will understand why the most consequential decision anyone has made about a soda factory in the last 20 years was the decision not to own one. Start with what the door costs. In 2022, PepsiCo's beverage division began work on what became its largest plant in the United States, 1.2 million square feet, roughly 152 acres of land near Denver International Airport, 3 times the capacity of the Brighton Boulevard facility it replaced, which had been running since the 1950s. It created around 250 new jobs and retained 250 existing ones, and the city approved $1 million in incentives to land it. PepsiCo never disclosed what it cost to build. But 3 miles up the road, Coca-Cola's bottler Swire was putting up a plant less than half that size and told the market it expected to invest between $350 and $500 million. Denver signed Swire a 75-year ground lease worth nearly $271 million for 97 acres. 2 rivals. 2 enormous factories, 3 miles apart, at the same airport. Not because the land is special, because soda is mostly water. Water is heavy, and heavy things do not travel far before the freight eats the margin. A smaller operation is not a small number either. Pepsi Bottling Ventures opened a 200,000 square foot plant in Raleigh for $40 million, running 4 packaging lines and more than 250 different products. One of those lines filled 12-ounce cans at 1,600 cans a minute, 27 cans a second. And that number is the trap built into the building. A machine that fills 27 cans a second is only rational if it almost never stops. You did not buy a factory. You bought a schedule that cannot be interrupted, and the building is never finished. In the first 36 weeks of 2025 alone, PepsiCo's net capital spending ran to $2.2 billion, and the company guides capital spending to stay under 5% of revenue every year. That is not a purchase. That is a subscription. Lines get retooled, package formats change. A new bottle size means new change parts, and none of it is optional if you intend to keep your shelf space. So the volume is enormous. Where does the money end up? In 2025, PepsiCo reported $93.9 billion in net revenue, up a little over 2%. Operating profit came in at $11.5 billion, down 11% from the year before. Net income fell 14% to $8.24 billion. Part of that drop was an impairment charge of just under $2 billion, tied primarily to the Rockstar Energy brand, and it is worth being precise about what that is. An impairment is an accounting write-down of what an asset is now believed to be worth. It is not $2 billion walking out of the building. Strip it out and the picture still does not flatter you. In the same year, Coca-Cola reported net income of $13.1 billion on Rue. Glee half of PepsiCo's revenue. Read that twice. One company sold about twice as much and kept substantially less. The difference is not the recipe, the marketing, or the blind taste test. The difference is the factory. Coca-Cola largely does not own them anymore. PepsiCo does. And as of this morning, so do you. So how does owning the means of production make you poorer? The answer sits in the segment table at the back of the annual report, which almost nobody reads. On a reported basis in 2025, PepsiCo Foods North America, the chips, delivered 46% of the company's segment operating profit. PepsiCo Beverages North America, the division that owns the plants, the trucks, the warehouses, the drivers, and the union contracts, delivered 8%. 8. A year earlier, that same division delivered 15. And here is the number that should genuinely unsettle the new owner. There is a separate segment called International Beverages Franchise. That is the part of the business where PepsiCo does not own the factories at all. It licenses the brand, sells the concentrate, and lets somebody else buy the filling machines. That segment delivered 13%. The version of this business that owns almost nothing out-earned, the version that NS everything, on the company's own reported numbers. Your factory is the physical expression of the smaller number. Every gallon of treated wastewater, every replaced conveyor bearing, every hour of a driver's overtime is a cost the franchise version simply does not carry. Meanwhile, the potato chips are quietly funding the whole apparatus. And the cost the franchise model avoids most completely is people. PepsiCo has told investors it intends to accelerate automation and digitization in production, targeting at least 100 basis points of core operating margin expansion over 3 fiscal years. Read that as a plan to remove cost from buildings exactly like yours. Every efficiency the parent company identifies is an efficiency you are expected to install, finance, and depreciate. That is the actual architecture of PepsiCo, a snack company that also fills cans. But the biggest live cost inside your building this year is not the syrup, the water, or the labor. It is the metal. An aluminum can is a commodity contract wearing a logo, and in 2025, that contract was rewritten twice. Section 232 tariffs on aluminum, in place at 10% since 2018, rose to 25% effective the 12th of March, then to 50% effective the 4th of June. In April, the Commerce Department designated empty aluminum cans themselves as a derivative product, which meant the finished can was tariffed as well. Now here is the part that reads like a misprint. More than 70% of American can sheet is made from recycled scrap aluminum, melted inside the United States. Recycled scrap is not subject to Section 232. American beverage companies are charged the full tariff-paid premium on it anyway. The mechanism has a name: the Midwest Premium. It was created as a surcharge to cover the cost of physically moving metal into North America, essentially a shipping and handling fee, and it is now benchmarked in a way that passes the tariff through to metal that never crossed a border. In November 2025, it hit a record high. Monster Beverage's chief executive named it directly on an earnings call as the reason his can costs went up. Understand what that means for you. You imported nothing. You bought American recycled metal from an American supplier, and you paid the tariff on it. Your cost of goods is set by a policy that has nothing to do with your plant, your suppliers, or your product. And aluminum is not the only input drifting away from plan. Analysts tracking the sector into 2026 have pointed out that both PET resin and aluminum have been running well above what PepsiCo's own guidance implies. Which brings us to the man who invented this drink, and the ingredient that destroyed him. In 1893, a pharmacist named Caleb Bradham was mixing drinks behind the counter of his drugstore in New Bern, North Carolina. He called one of them Brad's Drink. In 1898, he renamed it Pepsi-Cola, and by 1910, he had lined up somewhere around 280 bottlers. Then the First World War moved the price of sugar. Before the war, it ran about 3 cents a pound. After it reached somewhere near 28. Bradham did what a factory owner does when his main input is climbing. He bought heavily, in bulk, expecting it to climb further. It fell back to 2 or 3 cents. On the 31st of May, 1923, Pepsi-Cola was bankrupt. The assets, including the formula and the trademark, sold to Craven Holding Corporation for $30,000. They were resold shortly afterward to a Wall Street broker named Roy McGargall for $35,000, and revived again in 1931 by Charles Guth for $14,000. The brand outlived every one of those transactions. The factory owner did not. That is the entire lesson of this industry, compressed into one man's life. The brand collects the upside. The plant absorbs the commodity risk. Which makes what happened in 2010 remarkable. PepsiCo bought its 2 largest independent bottlers, the Pepsi Bottling Group and Pepsi Americas, for $7.8 billion. The Pepsi Bottling Group alone was doing over $13 billion in annual sales, with roughly 65,000 employees. The company took the commodity risk, the labor, the fleets, and the concrete back onto its own balance sheet on purpose. As part of the same restructuring, PepsiCo agreed to pay Dr. Pepper Snapple $900 million for a 20-year license to continue bottling Dr. Pepper, Crush, and Schweppes across those territories. So your plant may also be filling cans for a direct competitor's brands, under a license somebody paid $900 million to keep. Now let's talk about what happened in September 2025. Elliott Investment Management disclosed a $4 billion stake in PepsiCo and wrote to the board. The central demand was blunt: refranchise or spin off the North American bottling operations. Hand the plants to somebody else. Keep the brand. Do what Coca-Cola did. In December, after weeks of talks, PepsiCo announced a review of its North America supply chain, aggressive cost-cutting, structural changes affecting jobs in the United States and Canada, the removal of nearly 20% of its American product lines, and the closure of several manufacturing lines. But on the central question, the company held. It told investors that a full refranchising of its North American beverage operation was not under consideration. Instead, it is running tests in Texas and Florida that merge BV, Rage, and snack delivery into a single system, and it has said it will report back on the supply chain review in late 2026. Core operating margin moved up 140 basis points. to 13.9%. And the volume underneath your lines is not cooperating. In the fourth quarter of 2025, PepsiCo's global food volume fell 2%, while drink volume ticked up 1%. In February, the company cut prices on Lay's, Doritos, Cheetos, and Tostitos by as much as 15%, in time for the Super Bowl, after consumers pushed back on years of increases. Lower prices, soft volume, fixed costs that do not move. You already know which direction that combination pushes a factory. So the argument over whether anybody should own a Pepsi factory is not a historical question. It is open right now, and the answer arrives this year. So here's what you actually bought. A building that only makes sense at 27 cans a second. Sited in a city chosen because water is too heavy to ship, 3 miles from a competitor running the identical calculation. Sitting inside a division that produced 8% of its parent company's segment operating profit, while the potato chips produced 46%. Filling cans made from American recycled metal that carry an import tariff anyway. Priced by a premium invented to cover shipping. Bottling a rival's brands under a $900 million license. Owned outright because a company spent $7.8 billion buying these plants back, in an industry whose own founder was bankrupted by a bulk order of sugar. And a $4 billion investor is currently arguing that the entire asset class you just joined should be handed to somebody else. Either the integrated model is the moat, the thing your competitors cannot replicate and cannot buy, or it is $7.8 billion of concrete standing between a brand and its margin. The review that settles it reports late this year. You decide.